And thank you very much for joining us here on PM Express. Indeed, as you may have already followed and read, the IMF deal long closed, and the last few days, we've seen the full IMF program document. And what we've been doing since last week when Aisha was here was to now take it sector by sector and look at what the IMF program says about these sectors, the impact on these sectors. Last week we did the social interventions with a focus on the free SHS program, for example. Today, we're going to be focusing on the financial sector impact. And that, for me, is one of the most important parts of that particular document. And there's a IMF in the midst of the economic crisis. Now that we are out of the conversation with the IMF and now have a deal, we need to look back. So what is the impact? But also, what is it in this IMF program document that gives us a path to recovery when it comes to the financial sector? Stay with me, because this is where your monies are. And every economy cannot survive without a fundamentally strong financial sector. And so join me on this journey as we begin to pour through where we are, but also look forward based on the document that we have from the IMF. And the first thing that we need to look at is the IMF focus on the financial sector and what we're beginning to learn as far as this is concerned. Now, one of the first things that I want to draw your attention to is what the IMF itself says about how important the financial sector is in any of the programs that they sign up with any government, and Ghana is very important in this, is that the whole purpose, or one of the key purposes, a pillar of this program, is to preserve the financial sector. They want stability in the sector. It's so critical for the success of the program. If we cannot, at the end of this program, say that we have achieved financial sector stability, the IMF program would have failed. That, by the way, is how important this is. And so this is a starting point. This is according to the IMF itself. One of the key reasons why they agreed to do this deal with us is because at the end of it, they want to preserve the financial sector stability. So this is key. So bear this in mind as we go through the rest of what we have today. So another key thing. Now, in terms of this very important point of preserving financial stability, the IMF itself focuses on that, and then encouraging the private sector investment and growth. I'm trying to enumerate for you the financial sector objectives for the IMF program that we are currently on. Preserving financial sector stability, but also, most importantly, encouraging private investment and growth. And this is key. Remember that on the back of the DDEP, the Domestic Debt Action Program, it has really shattered people's confidence in the financial sector. Many people say, avow, they'll never buy government bonds again, for example, is one obvious reaction you get from people. And banks are struggling to attract fresh investments into the sector. I mean, recently, my bankers called me and said, do you have this, facility where you can invest in for your children? I said, invest for my children for the next 10 years. I don't know what's going to happen next year. I mean, if anything has happened, or any lesson I've learned in the last 1 year is you really can't tell where this economy is going, especially under the IMF. And so I'm really not sure whether I want to do that going forward. And many people, because of what has happened in the last year, they don't have faith at all in the financial sector. The IMF is saying that part of the reasons why they've done this, the second key objective that we isolated from the document, as far as the financial sector is concerned, is to encourage private sector investment and growth. So by the end of the program, how will the IMF measure success? If they can see at the end of the program that people now have renewed confidence, the confidence is back in the financial sector and people are willing to invest again, that will be a key mark of success of the program. So watch this as we go for the next 3 years going forward. And then also, another key point to note is also at the end of the program and during this program, devising and implementing all these strategies to rapidly rebuild financial institutions' buffers. And that is important. every financial sector will need these buffers in case of the shocks so they can actually absorb them. And so another way of measuring the success of the program at the end of the 3 years is if the buffers have been replenished, I guess, going forward. And then, of course, the beast in the room, as we know already, the asset composition of the banks, right? Domestic bonds is the most important asset class held by a lot of the banks. And really, this is where the problem is. And that is why most of the banks were in trouble. The commercial banks were heavily exposed to bonds. Instead of giving monies to businesses to work and give out all these loans and invest in the real sectors of the economy, there were a lot of them were doing what many people have called lazy banking. They were simply giving monies to government, taking government bonds. And that is why when the domestic debt issuance program hit and the crisis hit and they had to now take haircuts on the bonds, many of the banks have been left significantly exposed. Pension funds have been significantly exposed because a lot of them took your pension fund that you put in your premiums and then they put it straight into government bonds. Asset managers have the same problem. And as you may well by now know, insurance companies also are heavily exposed. We haven't heard much from the insurance companies as far as this impact is concerned and how they're managing it, but they are significantly exposed as well. Now, this is the big number here. Banks held 30 to 50% of the total assets in government securities before the DDEP. That is how significant the challenge was going into DDEP. So when you are this significantly exposed, any problem when it comes to government assets are concerned will hit you hard. And that's why the banks have been hit extremely hard as far as this is concerned. Now, this for me is an exciting bit. And numbers do not lie, but they tell a story. And this is according to the Ghana Banking Industry Report. And one of the things that we begin to observe in this report that you have here is that when you look at some of the key banks, and let me just begin to populate it for you, right? You begin to see that even during COVID, the banks were still doing well. Because if you look at it, for example, 2020, you look at the profit before tax, it was 6.05 billion. That's a lot, right? And then you look at the profit after tax, it was still in the region of 4.24 billion. So they were doing well. And then you come to 2021. You look at, again, doing well, 7 billion, 4 billion. And then post 2022, post the DDEP, which we experienced, towards the end of last year and all the conversations around it and coming into this year and closing it, you see what we are seeing now? That is the picture. Now they're in a negative. They've lost significant amounts, right? So the banking sector have lost almost 7.42 billion there. This is before tax, and you look at 6.02 billion after tax. So that tells a story that the domestic debt issue has had a significant impact on these banks. And this is astonishing if you look at it. They were doing well. It tells you if you're measuring the DDEP, its impact is significant, right? Again, if you look at some of the top banks, and we have isolated just a few of the top banks, we're talking about the big banks in terms of their assets and in terms of branches. Just isolating 5 of them to tell a story. If you look at Zenith Bank, for example, they've lost 550 million Ghana cedis. If you look at APSA, right, 560 million cedis as well. If you look at GCB, 701 million. If you look at Cowbank, more than $1 billion, right, lost there. And then the big one, CBG, 2 billion lost in that particular time period. Again, according to the Ghana Banking Industry Report. So these are fascinating numbers. 15 out of the 21 banks registered losses in 2022 alone. And these are just a snapshot of the big losers there. So everything isn't right. The key question that we need to be asking is, does this program provide a vehicle, an avenue for recovery for some of these banks in a sector? Now, this for me is important, right? The financial sector is hugely exposed to government debt, state-owned banks in particular, as we see CBG story there. And then you look at the the significant risk that the domestic financial sector stability is also posing, significant indeed. The exposure to the DDEP is causing significant headache for them. And the value of the assets, as we see currently, will decline to about 70%. Okay? Per value, owing to the coupon reductions that we've seen. So this is interesting. And if you look at the banks, a lot of them are taking this hit. I'm sure many of the banks and the boards are trying to meet and trying to figure out how do we turn this around. The key question, the reason why we are doing this is to ask the question, will the IMF program provide some form of a path to recovery for the banks? Now, what are some of the mitigation measures that we've introduced, the Bank of Ghana has introduced? Temporary regulatory forbearance is one of them. They've also introduced, as you may, lower cash reserve requirement for the banks, lower adjustable capital requirements have also been introduced for the banks. We also saw existing purchase agreements and emergency liquidity assistance that has been put in place. The banking sector stability fund, for example, that has been introduced for the banks as a result of this. And then you have that's what I was talking about, the financial stability fund, the financial stability fund that has been introduced. The key question to ask is, has the fund been set up? Is it ready to be disbursed? Because the banks need that. We need an update on this now that the deal is closed. The World Bank was prepared to provide some support to this particular fund, some 250 million. What we need to do is to break down where this is going to go, because a total of 1.5 billion is what we need for that particular fund. The IMF is willing to provide $250 million. If I'm not mistaken, this should be a significant amount of money there. So there's a gap there. The remainder of the 1.25 billion is what we don't know how government is going to source that fund to fill in that gap. But the World Bank is ready to put in some money, 250 of that, for the banks to access. I don't know, or checking my guests who are joining us, whether they are in the know whether this financial stability fund is in place and operational as of tonight for the banks to access, having seen the challenges that we've said and seen that they are facing. Right? So these are the numbers. This is the World Bank numbers that they are willing to put in, 250 million. And if you look at it, the disbursement in 2023, they want to put in, that is this year, they put in immediately 200 million. So we're expecting 200 million to come in, $200 million to come in from the Bank of Ghana, the World Bank. And then in 2024, they put in 50 million into it. So that's how they're proposing to spread this. If you go to 2025, they're putting zero. If you go to 2026, they're putting zero, and then it goes on. So that is how they are spreading it over the period. And so we're getting a significant amount immediately. The Bank of Ghana themselves, this is the World Bank. The Bank of Ghana also put up some measures to assist, right? For example, the capital adequacy ratio for the banks had been, we saw a reduction in that to 10% from the 13% that would give them some sort of leeway to operate. The key question to ask is whether this has been helping to turn the banks around. But here is the thing that I really want to draw your attention to. The IMF program, right, itself also has made some recommendations in the program document that we've been reading as far as the financial sector is concerned. And these are the three top ones that we found that are interesting. The first one is that in this document, the IMF's position is that, of course, the financial sector needs to be strengthened and the safety nets must be put in place. And they are asking the Bank of Ghana to closely monitor not only the bank, but also the non-bank as far as their liquidity is concerned. They also have asked that the Bank of Ghana should design an adequate bank and non-bank recapitalization strategy. That's important. What will be the strategy? Can the banks even find the money to recapitalize? And can government, the Bank of Ghana, provide the assistance? Are we in a position to provide assistance for this recapitalization? What would the strategy be? But for me, the most important one is the last one, this one. Encourage acquisition, mergers, if needed, is in the IMF program document. You know why this is important? That was the last one they proposed and the government has signed on to, is that they anticipate that maybe these 2 points here may not work. And some of the banks possibly may fail. If that's the case, instead of allowing them to fail, encourage them to merge. That is very, very important to note in the IMF document. Encourage the banks to merge instead of them collapsing. So there's an anticipation by the in this particular program that we may have challenges with some of the banks going forward, and we may see a few banks coming together. We may see acquisitions, we may see measures. It's in the IMF program document, which is interesting already. So that should set a tone for some serious introspection. After this break, my guests will join me, and then we'll expand. This is just to give you a snapshot of how far we've come and what the program is saying about where you save your money. At the end of the day, the IMF tells us one of the key objectives is to ensure financial stability. Key question is, the roadmap that I've just described, is it adequate to restore or to guarantee financial stability in the next 3 years? That is the first question I'm putting to my guest after this break. And thanks for staying with us here on PM Express as we continue to dissect the IMF program document and learn a bit of the details. Tonight we are focused on the financial sector. My guest who are joining me right now is Dr. Richmond Tiahene. He's a banking consultant, had done a fantastic study on the banking sector post the DDEP. Joins us Professor Godfrey Bokpin. He's a friend of the show. You know him. He's an economist and also a professor of finance at the University of Ghana Business School. Also joining us is a man who used to head the Securities and Exchange Commission, and he's become very popular in the last few months because he is also the convener of the Pensioner Bondholders Forum, Dr. Edu Ananientwi. And thank you, gentlemen, for your time. And I want to get straight to it. And I know, Edu Ananientwi, I'll come to you because you issued a statement tonight, and that will come into the conversation towards the end as we measure the IMF goal of restoring confidence and investment back into the financial sector. It really is at the heart of your protests. We'll come to that. But let me go straight to it now. I want to bring in Dr. Tiahene. Doc, so all the things that I listed, that the interventions that the BOG has done, the interventions that we are expecting because of the IMF program, are they sufficient to restore confidence in the financial sector, but also guarantee stability?
Thank you very much, Evans. From what I have done, the study that I have done, and the implications or the findings, I think we could have gone further because the losses, as you just said, is basically capturing about 55%. We have impending about 17.1 billion to be captured. Some of the banks were very good and they were able to capture the losses at a go. But if you look at the document gave them 4-year period. So some banks did some percentages, some did half. But if you aggregate them all, we're talking about 37.1 out of 19.4 billion has been captured. Looking at it from that angle, I think we could have done better because from where the shareholders are being required to produce capital plan. And this capital plan is based on the losses, the whole 4-year period losses, and then come out with a plan. Don't forget, about 3 years ago, we have to do bank recapitalization. So just about 4 years, you are calling on the shareholders, especially the private domestic banks. The private domestic bank. For the state bank, it belongs to the state. For the foreign banks, as we have read from Bloomberg and from Fitch, most of the foreign banks have already started coming with a capital plan to accommodate these huge losses we have inflicted on ourselves. So where I said, it will be very difficult to say that what they have put in place will be quite sufficient to deal with the program for the next 4 years. I think it's not, for me, where I said it's not going to be, because it is not only the losses to the capital. As you said in your opening statement, the confidence in the industry, both in the financial industry, including the banking sector, is not going to recover as people think that it's going to recover. It's going to take a long time. If we look at even, we're not talking about the liquidity. For the liquidity, I've always said that because of information asymmetry in the industry, nobody is running here and there to look for their monies. And I believe that we could have done better. Okay. Because the banking sector or the financial sector would need at least about 3 billion to be able to recover, including the pensions, the insurance, and the banks. So for me to comment on this,
yeah, so don't need
from where I sit and what the work I have done, I don't think it is quite enough.
Okay, I mean, stay with me. I want to bring in Professor Bockwin into this. Prof, so Dr. Chahini says the banking sector would need about 3 billion to ensure that they are stable. If you look at the Financial Stability Fund, it's just $1.5 billion. This is in excess of 50 billion. So that was supposed to be the government intervention that would ensure that the banks remain liquid and also do not go under. If you throw in the IMF program that we are currently on, I'm curious to pick your thought on what difference this IMF program makes to the survival and the strengthening of the financial sector going into the next 3 years. How much of a difference does it make, if at all?
Yeah, thank you very much, Evans. Good evening to our cherished viewers. I think that the 17th IMF-supported program is different from the 16th IMF-supported program in terms of its capturing of the financial sector. If you look at the way the 16th IMF program was designed from April 3rd to April 3rd, 2015 to April 2019, the financial sector vulnerabilities were not heightened, okay? And therefore, but in the course of the program implementation, it became obvious that the financial sector needed some kind of a resolution. And therefore, as part of the new Banks and Deposit-Taking Institutions Act, there were specific provisions that were included in that act to empower the central bank to be able to resolve the crisis. But this time round, even though it's an economic program, largely, it spends a lot of its time focused on the financial sector. It's simply because of what the financial sector has gone through from two levels. One, from the macroeconomic instability itself, and then, to make matters worse, the domestic debt exchange. Okay, so, and to that extent, the IMF knew that without adequately capitalized banking sector, the overall program objective cannot be delivered. We look at it from different ways. If you look at the IMF program itself, the costing, the financing gap in the next 3 years is about $15 billion. We expect that majority of that in translating the program into actual, because non-concessionary funding is not encouraged under the program till after 2027. So we are relying more on concessionary funding, right? So we expect that to come from the IMF, the African Development Bank, and the others. But the bulk of that is expected to come from external debt restructuring, almost $11 billion or so, right? Beyond that, if you want to finance the overall economic growth strategy, you will need a robust and adequately capitalized banking sector to finance that. That cannot come from central government balance sheets. That is where the problem is. Now, and I also agree with Dr. Chiahine. Look, Evans, the losses we see in the books of the banks is managed. It's managed. We have managed it.
You mean you mean to say that it is actually more than what we are reading?
That is my considered view. I'll explain more from a technical and professional point of view. So a borrower has been declared more or less like not credit worthy that same borrower in the short-term market, in terms of treasury bills, right, and the rest, is risk-weighted at 0. Then in the old bonds, because Bank of Ghana wanted to encourage the banks to tender the old bonds for the new bonds, we risk-weighted the old bonds at 100%. And then the new bonds, we risk-weight them at 0%. But remember, it's the same borrower. The character and shape of the borrower in terms of credit rating really hasn't changed. And the rest of them, it's purely accounting treatment issue, right? And the rest of this is what we have done. So if you see the differences, even from some of the banks that are recording minimal profit, you will see where they are exposed. Those in the treasury bill, because we are not calculating any expected credit losses from there, right? And all of that. So I think that, and if you see the IMF's assessment of the banking sector, the financial sector, you could see that they are touching some high degree of risk in there that requires some level of attention. Now, if you want to do domestic debt exchange, actually, in addition to the regulatory issues in terms of eliminating the 3% capital conservation buffer, essentially reducing the capital adequacy ratio to 10% from 13%, and the other measures, the regulatory forbearance and all of that, you needed to have actually operationalized the financial sector stability fund, because that is an ambulance that you are putting down, right, in case that if you apply the treatment and some banks needed that support, it will be available. As at now, it hasn't been operational.
Yeah, but on that though, I mean, as I shown, the World Bank is ready to give us $250 million. Yeah. 200 million is ready this year. The missing link there is the remainder of that money, which is the overwhelming bulk of it. We don't know where government is going to source the funding from. But also under the IMF program, where does government go to get the money to plug that hole and provide the stability fund in place? Is that even feasible?
Yeah, that is a challenge. But in the first place, why should we, if the government had the money, they should have taken the money and allowed the banks, right? Government should just honor its bonds and the rest of them. I just find it a bit uncomfortable that some way, somehow, through the state and its managers, we want to make banks so dependent on the government support to be able to have their going concern. Look, if you look at the way we did the financial sector cleanup, right? The minimum capital requirement and all that. Some domestic banks, owners, they've lost their banks, right? Others have lost it to GATT and all of that. I think we are creating some level of uncertainty, right? And if you look at banks' capital today, I mean, they could easily become subject of acquisition targets and the rest of them. Even though we will say that in finance, there's nothing wrong with that if through mergers and acquisitions we consolidate the sector and the rest of them. But we are looking at the uncertainty that we are creating.
Yeah, but Professor Bokwing, since you touched on this merger and acquisition bit, I want to bring back in Dr. Chiahene. And Dr. Chiahene, that is an important... okay, I understand that we lost him briefly, but Dr. Edu Ananientwi is on, so I need to put that to him. I mean, Dr. Ananientwi, this is an area that you supervise in the financial sector. You're the SEC boss, etc. I know you have issued a statement tonight. I'll return to that in quite some detail. But considering where we are, considering that we are under an IMF program, what's your assessment of the current state of the financial sector, for example? I mean, the challenges are obvious, but the path towards recovery, does the IMF program offer us that path? I mean, Dr. Chiahene believes it is the program going forward isn't adequate because you need more funding. What's your own assessment?
Thank you. To be honest, I haven't reviewed the whole IMF document. Mm-hmm. But still, I would say that you need funds to stabilize this market. My concentration will be on the stability, financial stability. I get worried when the people at the Bank of Ghana always think that the banking sector stability is almost equal to the financial sector stability.
Isn't it?
They are always
isn't it? I mean, the banks are the superpowers in the big field.
They are bigger. They are bigger.
Yeah.
They are bigger. But we shouldn't think that when you stabilize the banking sector, you have stabilized the whole financial sector. That is not true.
Please explain. Because
That
many
is
will say
not-
it's as simple as that. The focus should be on the banking sector and not.
It's not as simple as that. Even though, you see, the point is that we have historically been relying on banks in our financial sector. And we haven't moved from there. The Bank of Ghana itself has promoted other non-bank financial institutions, we called them previously. Now they are specialized deposit-taking institutions. And yet still, when they are talking about stabilizing the financial market, they think if you stabilize the banking sector, you have finished. That is my worry. That is my worry in all these things that we are.
But why is that? Why is that a worry though?
It's a worry because it's not only the banking system that constitutes the financial sector. You see, it has been the problem, and I have had issues when I was in office. Read the financial stability report that is prepared by the Bank of Ghana. You will see just about a paragraph on the capital market or two. Everything is banking. Everything is banking. I attended a seminar with the former governor on financial sector stability, and everything that was discussed there was on banking. As if the banking still is the only sector in the financial market. Now you see, people, you are trying to encourage people to invest. Investment comes mainly from the investment companies and the financial houses, finance houses. They are basically people who take investment. They are basically people who take the investment. The mutual funds, the securities industry, they are basically investment takers. They take investment from people and channel it to other people. You want to encourage these people to take investment from people. You want to encourage people to invest. And you are thinking they are not part of the financial market to ensure that there is also stability there. And you are thinking of only banking. And you think you have solved the problem. No. Look at the amount of money that is locked up in the securities market and in the finance houses. You can't say you have stabilized the market, the financial sector, unless you say you are stabilizing only the banking sector. But if you are saying you are going to stabilize the financial market, then until all these people have gotten access to their capital, access to their investment, you don't talk about stability in the market. And that's why I have been saying that government should try and convince the development partners, especially the World Bank, to let the government use part of whatever World Bank will donate for this financial stability to pay out all the lock-up funds in the market. That is where you start to build stability, you start to build investor confidence in this market. Not when people's money are locked up, they cannot access it. You are talking about financial stability, you are talking only about banking, stabilizing the banking, and leaving the rest to go, and people who have to go on the street to be arguing and demonstrating for their money, and you are talking, and you say you have stabilized the market, stabilized the financial market. Until we do that.
Yeah, I mean, so you raise an important you raise an important point. Let me bring into the banking consultant with us, Dr. What do you make of that position that we've had in all this conversation? Even the IMF document, you see it reflected there that the focus is on the banking sector. Really, is that a fair point he's making? That going forward, as we try to rebuild the financial sector, it's possibly injurious to this economy, the long-term life of this economy, if our focus is almost solely on the banking sector?
I think Dr. Anane, to a certain extent, is right. Although the banks hold about 30 to 50%, at least the rest is held by other MBFIs. So if you concentrate alone on the banks, then basically you're leaving the other sector. But they all come together. At least the bonds. It was not only the banks. The banks hold about 50%.
Yeah.
But what about the other 50%? So what Dr. Anani is saying is that whenever we're talking about financial sector stability, it should be inclusive, all in all, so that any decision that we are taking, we bring all the sector, including the banking, into good perspective, so that we don't take a portion and leave the other portion. Because if you leave the other portion, there is what we call contingent effect or seismic effect. It can affect the whole sector. So to what he's saying, he's trying to say that a time has come for us to change our perspective. Because if the banks are holding 50%, who is holding the other 50%? So we should have inclusive so that we can tackle the issue head on, rather than as if there's only one banking sector, but there's only one sector, which is the banking. What about the other one? The mutual funds, the insurance people, the pensions, and what have you. So what Dr. Anane is saying is that anytime we begin to have the argument, let us have the argument in totality. Call it financial sector stability.
Yeah, I mean,
they didn't say no. Bank of Ghana didn't say banking sector stability. So I think implication is that what Dr. Anane said, the Bank of Ghana should come out clearly so that it will not put it will alleviate people's fear. Because anytime we are talking as if the banks, but banks hold 50. Who hold 50? So that is so my argument is that what Dr. Anand is saying, that it should be inclusive.
Yeah,
so
I mean, Dr. Chiahene, though, if we look at the IMF document, and I illustrated at the beginning, one of the last point that in terms of the program prescription is that the Bank of Ghana should almost encourage acquisitions, mergers and acquisitions. And you look at that, and it almost suggests that there's a plan, but there's an anticipation and expectation that the plan that we have may not work. And so instead of allowing the banks to go under, encourage them to merge, how viable a proposition is that in this IMF, under this IMF 3-year program?
I think from what I've just told you, if we leave the domestic side out of the equation and follow the foreign people have the appetite. Because if you look at the banking industry in the whole Africa, Ghana has got one of the profitable sector in the whole country, in the whole Africa.
You mean the banking sector? Or the financial sector? Banking sector.
Yeah, the banking sector. Because you see, it is only in this country you can take a deposit 20 and make a loan 40%. In other jurisdiction, it doesn't happen like that. So the foreign banks have realized that. And the document is actually taking our minds to where the foreign institutions would possibly have to acquire those weak Ghanaian banks. And that is why in my first statement, I said my only concern is that we should build a strong domestic banking sector. I mean domestic, indigenous. Because you see, when the going get tough, the foreigners will run away. There is no two ways about that. They will run away. So
far, they weathered the storm together with us all.
So far, they have mother companies to support their capital. Other than that, you hear APSA came and said that, they are going to recapitalize. I heard about Zenith is doing the same. All the banks, South African banks are all doing it. It is common on Bloomberg, but none of the banks in Ghana. That is why the reason why I said that we should look at the financial, what you call the banking stability or the financial sector stability, and beef it up so that we can find a means. In Jamaica, when they did it, they realized that if you don't take care and you lead yourself to the foreign and they leave you, you're going to have a problem. So they realized they created structures that will help the indigenous banks to continue to grow. So that is my only concern, that if you make that statement that the IMF is making, it's taking our minds to those who are already wealthy in terms of bringing capital to take over our economy. And our economy cannot, let me repeat, it cannot be led by any foreign institution. It has to be done by Ghanaians. Other than that, what Kwame Nkrumah said would have been a failure, because we have institutions here. If we bring them up, I believe this country, especially the domestic bank, I know some of the owners. I've spoken to some of the owners. In my research, I go to the shareholders and they are worried. So I think Bank of Ghana should look, and the stability and the Minister of Finance should look at it from this perspective that we need a strong domestic institution. Look at Nigeria. Look at Nigeria. Foreign banks go there and they are not able to perform very well. Rate all the banks that in this country are doing well. They are not doing very well in Nigeria because the Nigerian domestic bank is very, very strong. And that is where I am coming from. We are Ghanaians and we must be ready to damn it and support the indigenous bank.
Yeah.
Having spoken to the shareholders, let me finish. I've spoken to shareholders, I've visited them, and they are all worried. They are worried. The anxiety is that bring a capital plan. Where are they going to get the money from? Where? In this time of economic hardship, you want somebody to inject money into it where he hasn't created a problem. What Ghanaians are refusing to understand, it is not the shareholders who created it. It is the government who has created it, and he must be able to support them to come out of this crisis. This is my take on it.
Professor Bokwin, what the IMF program states specifically on that point, that the Bank of Ghana must implement a recapitalization strategy. I guess it's the point that Dr. Chahane is making. We have a few minutes to wrap up, but I need you to close for me on a point, and I'll bring Dr. Chahane in on the point as well. But close me on a point. So you have 3 years now under the program. We need to restore confidence, and we need to guarantee and ensure that there is financial sector stability in the next 3 years. Bullet for me, what's the best way to achieve this in the next 3 years? Is it even realistic to expect these two pronged objectives to be achieved in the next 3 years? If not, what do you do to do so? Briefly.
Okay, thank you very much. I think in totality, the 17th IMF program is designed with extension in mind. Okay. So we should just understand that it looks almost certain that Ghana will ask for extension after 2026. Because if you look at some of the objectives outlined, even including debt sustainability, we can't have that by 2026 and all of that. So at the program end review, we will certainly make a case for an extension. Mm-hmm. But the point is that what we need to do right now, and I agree with Dr. Edouard and the entry, that there's so much pain in the system. I think with the IMF program, government needs to now sit down and calm the markets.
How?
Part of
How?
Part of that will be, let's have a credible plan of paying on government bonds, predictably, okay, as a way of restore. You just can't restore confidence by mere words, okay? And we need to have that. And the focus should not only be in terms of the banking sector, but we also have to look at the capital market, investment, and the rest of them. Let's begin to iron out all this. Let's have some kind of predictability, okay? When people see that, well, government is paying, is honoring its bonds and the rest of them, if people have to plow back the funds, because right now, people are withdrawing money, and people are looking at other ways of keeping the money rather than plowing it back in the financial system. That itself would affect the liquidity and deposit mobilization of banks and the rest of them. And then to add to what Dr. Edouard said, look, we need to be intentional in increasing local content in our banking industry and expand that across other industries. We cannot, and we should not make it a goal that it should be the fact that local banks are worth so little in the books, they easily become target of acquisition and the rest of them, then that means that we have solved the problem. No, we can't do that. And that is why I said that, look, it's almost becoming like a trap where people with their invested funds and the rest of them set up businesses, maybe in the banking sector, and after a while, through whatever means, they easily lose hold of their banks, right? We've seen that. Okay, so let's have some kind of predictability, confidence, so that people can actively grow their businesses at the level that they think that is acceptable, rather than, I mean, it's just not good. I'm saying that it's just not good, and it doesn't help in terms of build. Look, and we've seen it in Ghana. Look, and not only in Ghana, Africa broadly. Ghana's domestic private sector are uncomfortable plowing back their money in this economy. People are okay to invest in Dubai and other countries because they are not so certain what will happen here. If you look at the total wealth of Africa's high net worth individuals is over $900 billion. More than 60% of that are invested outside the continent. Okay, meanwhile, it's the same continent that goes to the Eurobond market annually to mobilize billions of dollars at a very expensive rate. Meanwhile, we don't have a credible plan, predictable, that offers comfort and safety in that allows people to actually invest their money in the domestic economy.
Yeah.
Where are we going with that?
Yeah, I want you raise an important point. I want to quickly bring in Dr. Donanoinchi on that subject of confidence. Doc, you this evening have issued another statement. From what I read, you are resuming your protest at the Finance Ministry this Thursday. I thought the Finance Ministry had cleared the overwhelming majority of the outstanding coupons. Have they not?
In the first place, that shouldn't have happened. And we have told government that government should try and restore public confidence in our market. Public confidence. So we thought when government said, I'm going to clear every arrears, they were going to clear it. Absolutely every arrears was going to be cleared. Government didn't do that. It cleared and left some. We said clear all. Then another big factor is the principal, people's principal. You see, you are in the market, you have invested your money with the issuer. You've granted the issuer 5 years, 10 years, 15 years, or whatever. Now the 15, 10 years, 5 years come, and the issuer is refusing to let you have your principal back. Is that how to restore confidence in this?
How many bonds have been affected by this non-payment of principal?
All bonds now. The first one is 97 days now. And I tell the ministry that, look, when I started investing, I was very much interested in the 30-day T-bill. Because as a worker, I wanted to top up my investment every month. So the 30 bill was good for me. Government was borrowing at 30 days. Then they stopped it. Now, if you were borrowing at 30 days, you are keeping some people's money for more than 30 days. How? How would you let that happen? Then to something this. You are keeping people's capital that they needed to reinvest. So what signals are you sending to the market? That even when I take your money and the time comes for me to return your money to you, I will be unable to return it. And nobody is talking to you. And I have said government must pay interest on that. There is no free capital in the financial market. You can't take people's capital for more than 3 months and refuse to pay them something. We cannot even fight half of the inflationary pressure.
So you are returning to the finance. You return to the Finance Ministry on Thursday.
Yes, and we were there every Thursday and Friday. We are doing that because we want to give government some time. Every coupon or bond matures on a Monday. If government want to return to normalcy, if the bond or the principal or the coupon is matured on Monday, the government will give instruction for its payment. Latest by Wednesday, we should see some payments having reflected in people's bank. Then there will be no picketing. Okay. And if by Wednesday nothing has happened, then the picketing will continue every Wednesday, every Thursday and Friday. Then the next Monday, you give the government opportunity to clear things on Monday, Tuesday, Wednesday, because some other bonds some other coupons might have also matured on the Monday, or another bond might have also, a principal will be due on that Monday. So that is what we are going to do.
Okay.
So if by Wednesday we know that what is due on Monday is being paid, there will be no need for picketing. Okay. But until that is done, the picketing will continue when we resume, and every Thursday and Friday we shall be there.
Thank you very much, Dr. Donanoinchi. Thank you, Professor Bokwe. Thank you very much also to Dr. Chiahene for joining us with your thoughts there. So that's a financial sector analysis from the IMF program. Tomorrow we'll try and bring the labor to the table, TUC and others, for a conversation about the IMF program and how they are reading the document as far as it affects their lives. Join us then.